welcome to another episode of the Michael Yardney podcast, where twice a week we like to dive deep into the trends, the challenges, the opportunities shaping the Australian property investment landscape. Now, if you've been wondering what's going on in the world of investing at the moment and what lies ahead, you're in for a treat today because we're going to be unpacking the findings of the 2024 Property Investment Professionals Association annual Investor Sentiment Survey. And that gives us a comprehensive snapshot of how investors are feeling. And boy, are the markets changing in front of our eyes and as the mood of investors changed. And I'm joined by Nicola McDougall, the chairperson of PIPA and an industry expert. We're going to be discussing the factors that are driving investors to exit the market at the moment, the impact of rising costs, government policies, and what it all means for the future of investment in Australia. Wherever you are along your property journey, I believe this episode is going to be one that's going to give you some information. So let's get started.
Welcome to the Michael Yardney podcast, where twice each week you will learn a number of new ideas regarding success, property investment, and money in around 30 minutes. Our show is brought to you by Metropole, who specialise in helping you grow, protect, and pass on your wealth through strategic property and wealth advice. Now, here's your host, Michael Yardney, Australia's authority in wealth creation through property, who has been voted one of Australia's top 50 most influential thought leaders.
The sell-off of investment properties around the nation is continuing, seems to be going on unabated, and it's fueling fears of an even tighter rental market with higher holding costs and compliance costs, as well as proposed taxes. I guess that's the blame of it. Well, that's according to the latest 2024 Property Investment Professionals Australia Annual Investment Sentiment Survey. Now, this survey is in its 10th year, and it found even more investors sold a property than the year before. So to find out exactly what's going on, to unpack the findings, I'm pleased to again have a chat with Nicola McDougall, chairperson of Property Investment Professionals of Australia. Hi, Nicola.
Hi, Michael. How are you, my friend?
Good, thank you. Now, I was very impressed to see your survey this year, which is even more comprehensive, very detailed, and I'll leave a link to it in the show notes because it's full of great information and also graphics. Now, you've been running it for a long time, but this year it was even more detailed than ever, wasn't it?
It was, and as I think I've said on your show, Michael, every year, certainly over the last few years, we try to, include new questions to, understand a bit more about what's happening on the ground right now with investors. And this year as well, we decided pretty last minute, I must admit, to kind of rebuild it from the ground up. So it was a ginormous project that we probably should have thought about doing a bit earlier than we did. But fundamentally, what that meant was that we could really drill down much further than ever before into buying activity, sentiment, selling activity, selling sentiment, and these types of things, which we probably, had been asking over recent years, but this was much, much more detailed. And what that meant was that the survey was actually twice as long as ever before. So I must thank all of those people that took between 20 and 30 minutes of their day to fill out the survey for us so we could actually understand a bit more about, what's happening out in the investment market at the moment.
Well, it went to a select audience, people who are property investors and clients of the various members of the Property Professionals of Australia, PIPA's members. And I guess the first question I'd like to ask you about it is, were there any surprises that came out of this year's survey for you?
Look, there's many, but I guess the most simple one is the fact that the percentage of survey respondents who said that they'd sold a property in the previous 12 months was higher than the year before. Last year it was 12%. This year it was 14%, and that represents 1 in 7 investors who have said that they've offloaded one of their properties. So that was probably a bit of a surprise. I kind of thought, given that market conditions last year we're probably more even around the nation. This year we have, a quite disparity between market conditions depending on the location. I kind of thought that maybe that investor sell-off had lessened, but it hasn't. And there's a variety of reasons why our investors are doing that, and generally it's based on what's actually happening at policy level in the location of their investment properties.
Well, I hope the politicians, especially ones of a particular colour persuasion, are going to be paying attention to this information because it's actually telling how people think. And I know it's a small number. It's not a small number. It's a substantial number, but it's a representation of over 2 million Australians who
Mm.
own investment properties. What do you think was driving this trend for investors to leave the market, particularly as you say, it shouldn't have been much worse than the year before?
No, exactly. And even the fact that, people go, oh, it's only 2 percentage points, but, how many properties does that represent when you've just said that I think it's 2.2 million Australians have an interest in rental properties around the nations? We're potentially talking about tens of thousands.
Yeah.
It's not just 2%. But I think the survey found that the number one reason was an increase in holding costs across a variety of things, such as an increase in insurances. We've certainly all seen a massive increase in the cost of insurance, costs associated with minimum housing standards legislation, which has been implemented across the country over the last few years. And clearly, all good investors want to have a home that is not only habitable but in good condition. But when you have legislation brought in carte blanche that requires you to perhaps spend quite a lot of money to bring that property up to what is considered to be the new standard legally, investors are having to fork out more money to do so. I sort of thought,
We weren't prepared for it, Nicola.
no, well, that's the
That's
thing.
part of the problem of this, isn't it? Tell
Yeah,
me the rules and I will play with them or I won't get in. But don't
yes.
change the rules when I'm in the middle of the game.
And you know what was interesting with the data, and I don't think, because we do have such a big data set now, it's not actually all in the first report that we've put out. We will be putting out additional data as time goes on because, we couldn't, just time considerations meant we couldn't create like a 90-page report or something like that. But we did ask them for the first year where the investors, where predominantly they got their information from a policy legislation changes from. And most of them actually either A, had to do their own research, or B, they relied on their property manager. Because the state governments, they decide to change these residential tenancy legislation often, or they create new, land taxes, such as in Victoria. That was a big reason why people sold, actually, new land taxes. But they actually don't have any way, they don't actually think of any way to communicate these changes to the people that it affects the most. So I
No.
thought that was really, really telling, is that, I've actually been in state government meetings about policies, and I've asked this question actually relatively recently, and they didn't really have any plan how they would communicate these changes to the general public, but certainly to investors, apart from perhaps, the information gets fed out to the local real estate institutes, and then the real estate institutes hopefully share it with the property managers, and then the property managers, third, fourth hand, share it to investors. So that's a big problem, like you said.
Yes,
They're
it
not
is.
the communication that needs to happen around these changes can't just happen through a couple of press releases that some media run stories on. It has to, but they actually have. But the major problem that they have is they actually don't have any way of communicating directly with investors anyway.
No, they don't. Now, interestingly, Leanne Jobson, our Director of Property Management at Metropole, has run a series of videos, webinars for our
Mm.
landlords in Melbourne, Sydney and Brisbane to tell them of the changes. And in fact, they had to be different ones for each state because the rules have changed. And there are, as you said a minute ago, minimum rental standards. Now,
Mm.
no one wants to be a slum landlord. Only just before we got on this call to record this, we're speaking with somebody in our office who was telling me of a client who took his property away from us because we said, sorry, now that the tenant has moved out, you are going to have to improve the standard and bring it up to the minimum standards, which would have cost quite a bit of money. And we weren't prepared to manage it because not only would he be liable, but
Yes,
in fact, we as property
that's
managers
right.
would also be liable and subject to a fine and, in fact, I believe, legal penalties. Having said that, the conversation came up because he actually found another property manager who was prepared to rent it out in its current state, which, let's be blunt, is illegal under the new legislation.
Yeah, exactly. I've heard some interesting stories out there as well. Not necessarily about that, but just about the onus being on investors over a very short period of time
Yeah.
to do these upgrades to their properties. And as the survey's shown, and we'll probably talk about it more in the show, Michael. Investors are already struggling with significantly higher holding costs than they have had, and then on top of this, another financial impost, which could be thousands, or, who knows, depending on the property, depending on the legislation and the location. Many investors are simply struggling to actually have the funds available to actually, make sure that they are meeting these minimum housing standards. I'm sure everyone wants to, every good landlord or
Sure.
investor wants to do that, but financially they actually might not be in the position to do so.
Well, let's talk about holding costs and negative cash flow,
Mm.
because I believe your survey showed that 70% of investors were quite a bit out of pocket. Now, there's no doubt that rents in almost for every property
Mm.
have gone up significantly, often with double-digit growth of rent. That's now seems to be capping out.
Yes.
It can't keep going up because of affordability issues, but holding costs have gone up even more than that, haven't they?
Yeah, and we asked a question in the survey this year, another new question of investors, thinking about the increase in their mortgage interest rates annually at the moment versus when they were at record lows during COVID. And I think it was around 65% or something like that, or up to 70% of respondents indicated that their annual interest bill, so we're just talking about interest,
Yep.
had increased anywhere from $10,000 up to about $60,000 or more dollars per year. Obviously, this depends on how many properties you have in your portfolio,
Yep.
but tens of thousands of dollars of increased interest repayments. And we also asked investors, okay, then if you throw in obviously a variety of other holding cost increases such as new land taxes, or other increases in property management fees, for example, how much of those total operation cost increases have you passed on to your tenants in the form of higher rents?
Yep.
And 55% of respondents said less than 10%. And that was the same result as last year. So, as you just mentioned before, Michael, affordability constraints will always dictate how high rents can go. The market sorts itself out eventually, but most investors are actually only passing on, in the form of higher rents, of quite a small percentage of what their total increase in operational costs are. I presume for a variety of reasons, but as we've often talked about on the show, smart investors, they want long-term tenants who are in their property over the long haul. And that often, means that, just because you have the ability to put up rent to a certain figure doesn't mean that most of us would, if it actually secured that tenancy for a much longer period of time and everyone was happy with the arrangement.
Sure. So, unfortunately, landlords are lumbered with extra insurance, extra costs, and some states have imposed vacant property tax. Now, that's not as big an issue for land tax, for investors, higher land tax, and it's made some investors shy away from certain states. But I found interesting, as I read your survey, which states investors assumed were investor friendly,
Yeah.
at the same time, which states they were going to be looking at where they should invest, when in fact they were different answers, weren't they?
I know,
So
and
it
I
had a
must.
long-term perspective.
I know, and I probably should have brought this stat up when you asked me that surprising, which one was the most surprising metric at the start of the chat. But this year, investors named WA as the state or territory that they perceived as being the most investor friendly. Uh, and look, WA clearly has had, Perth has had a very, very strong market conditions, hasn't had as many rental reforms, things of this nature. At the other end of the spectrum, the state or territory classed as the least accommodating of investors was Victoria. That was the same as last year.
No
So,
surprises there, by the
no,
way,
not at all, not at all. And we've only asked this question for the
because they're
last 2 years.
ugly, they're greedy property
Yeah,
investors.
and in Victoria, very on the nose with investors. WA investors are loving. What was interesting actually in the results as well was that last year Queensland, and by last year obviously that terrible interstate land tax,
Yep.
ridiculous law had been repealed. But last year, Queensland was seen as more anti-investment than pro-investment, versus this year it's actually seen as more investor-friendly than it was last year. So, policies can impact investor activity and clearly in sentiment, but also can market conditions. And like you mentioned, Michael, in your question, what was kind of converse to all of that is we also ask investors, okay, where do you see, who has the best investment opportunities right now? And they said Melbourne. So on one hand, and investors have sold in Melbourne is the second. So they sold the most properties in Brisbane over the last 12 months, and Melbourne was second. And in regional Victoria, actually, a lot of more sales in regional Victoria than last year. But so they've sold a lot. They think Victoria, the Victorian government doesn't like them very much and is not supportive of investors yet. In the same survey, the same cohort of people indicated that Melbourne was the location that had the best investment potential going forward. What's that about? I'm sure you have a lot of thoughts about that, Michael.
Well, I think if you asked Warren Buffett, he'd say, be fearful when others are greedy and be
I think
greedy
so
when others
too.
are fearful.
100%, counter-cyclically, 100%. But I've had a lot of conversations with people and been chatting a lot about the survey results, and particularly this metric. And I'd be interested in your answer to this, Michael, as someone who's local, in Melbourne. That temporary land tax, which is actually in for 10 years, how much of a drag on the local market do you feel that it currently has? Notwithstanding a change of state government at some point in a few years, is it likely to, have a more pervasive drag on prices there? Because let's talk. I mean, it's temporary, but it's a temporary measure that lasts for 10
Well, I'm not
years.
sure how temporary it is. Governments don't like giving back money that they're taking, Nicola. So let's just remind people who are not familiar with it that what they've done is reduce the threshold in when one pays land tax. So almost everybody who
Yeah.
owns interest in a property, even if it's a half interest, you end up having to pay land tax. So depending upon how big your property is, it's based on the capital unimproved value of your property. You're paying more land tax. But it's often only, we're talking a few $1,000s.
Yes.
The great thing about land tax is it's the only tax that's tax deductible.
Yes.
So
True.
therefore,
True.
you only sort of end up paying a third, 2/3 of it or a half of it, depending upon your tax bracket.
Do you think that the
I
market
think
reaction to it is a bit overblown?
Yes, it is. But I think it's an emotional thing. People don't think rationally when it comes to money, especially when it's on top of other residential tenancy legislation changes and vacant land tax and more, if you're in business, more payroll tax and governments taking money from you, treating you like an ATM. So
Mm.
is it the straw that broke the camel's back? I think enough is enough. Leave us alone and let us just get on with being small businesses providing rental accommodation for people who want it and don't penalise us. So one of the things that certain political parties are talking about is that investors are getting preferential treatment. But investors don't seem to feel that. They feel, well, it
How
is
is that?
preferential, but in the wrong way. People are ganged up against them. Interestingly, capital gains tax is on the agenda again, but what's not brought up is the fact that if you buy a home and you sell it after a couple of years or longer and make a couple of $100,000, as a lot of people are. So a lot of people, most properties that are sold are owner occupiers, either upgrading, downgrading, right sizing, moving, and they don't pay any capital gains tax at all. So in fact, owner occupiers have got amazing tax benefits that property investors don't have.
100%, and I know that the negative gearing genie was out of the bottle again last
Yes.
week, which my phone was ringing hot, and I actually did. I chose actually not to give it too much oxygen because I wasn't convinced that actually Albo would be that stupid, and it sounds like he's not, especially when he's been quoted. I think he quoted some property council research, and I've never seen a Labor politician doing that. But look, unfortunately, it's an argument that I don't think that's ever going to be one on either side. It certainly has become much more militant over recent years, and obviously you've been doing this for a long time, Michael, me too, not quite as long. But certainly I had this question the other day. it is much more militant now than it used to be. Like this us and
Yes.
them mentality, a certain political party that might be green in colour have really, really picked up and created a lot of anger out there against investors. They are, supporting false narratives around things, doing campaigns that are actually, untrue and things of this nature. Blockading good legislation in federal parliament, but by blackmailing, I suppose, almost, the current
Yes.
federal government to allow them to pass what is good legislation. So I think that has made it extremely more difficult. We always have these conversations. I mean, I think at the moment, over the last couple of years, the reason why it's always in the media so much more than perhaps it used to be is because we're in a rental crisis. I mean, things are grim out there. It's bad. Like people are more homeless. Like I walk down by the river here in Brisbane where I live, and I actually hadn't been down that way for several weeks, and I was down there yesterday, and I there had been a couple of tents there previously. Now there's probably a dozen or more. And these are people that clearly look
Terrible.
like they have children living there too. There was children's bikes and things. So things are very, very bad in regards to rental supply. But, my feeling is that we can all work together to create a solution. And I've said many times that investors are the solution. We're
They're a
not
big part
we're
of
not
it.
the evildoers. We are the people that have provided the majority of rental accommodation in this nation for years. And now we have a rental crisis. And one relatively simple way to improve that situation over the short term is to motivate investors to stay in the market where they financially can and encourage more either new entrants into the market or existing investors who have the capacity to add to their portfolio, because the market metrics are very, very strong for investors. But also we would love to be able to do our bit more to address the current rental crisis that we have, because without investors doing that, there is no end in sight to vacancy rates with a one in front of it.
Well, what you started to say was that there's more conflict, and
Yes,
I've never seen so much conflict between tenants and investors, and in fact, first home buyers blaming older generations for stopping them getting into the market. Having said that, there's been 1 million new first home buyers enter the market over the last decade. If you look at the finance figures that come out from Australian Bureau of Statistics every month, first home buyers are entering the market again. Yes, it's harder, but there's a number of government incentives, shared equity schemes and other incentives to help home buyers. So it's not investors who are stopping home buyers, or in fact investors who've created the rental crisis. As we've discussed in previous occasions, Nicola, it's really the rental crisis has been a number of years coming from various government policies. And sure, build to rent will help, and
yes.
getting more people to build will help. Not that they're doing that at the moment. I agree with you. The quickest and easiest ways to stop investors leaving the market and encourage investors. I am encouraged by the fact that the latest finance figures show that investors are entering the market. It'll be interesting to see the net figures, because some are leaving, some are
Yes.
entering. I guess we don't really know how many who are leaving and selling those regional Victorian properties, are moving to other states and actually just redeploying their money better. Did you have any sense of, when investors are selling, who is buying the properties?
I mean, over the last few years, we've been asking this question, and this year, of those investors who had sold in the previous 12 months, 44% actually sold to an existing owner occupier. So they sold to someone who perhaps, like you've said, was downgrading, upgrading, right sizing, whatever it might be. So that, has the potential for that property to no longer clearly be a rental property. There was this year, actually, like you've just mentioned, Michael, there was an increase in the number of those properties that were bought by other investors. Last year, I think off the top of my head, about 24% of those former investment properties were actually were actually bought by other investors. And this year it was up to 30, 31, 32%, I think, from memory. So you're seeing it there in action, right? Last year there was far fewer investors who were buying those properties, and this year there was more. So we are seeing, more volumes of investors coming back into the market. But again, like we often argue, when investors are selling and other people who are not investors are buying, well, those properties are likely to have been removed from the rental supply. And one only needs to look at the long-standing record lows that we have in regards to vacancy rates, because they're not doing anything. They might like tick up a little bit, go down a little bit. Obviously, we have in January, vacancy rates will probably fall through the floor again, but they're not changing in any material way. And they
No.
haven't for a long time. And so people kind of go, well, I hear people say sometimes, well, it's good that if investors are selling, it'll mean that more first-time buyers can get in the market. We love first-time buyers getting in the market. I love that. We were all one once. If there's not enough investors in the market, then vacancy rates will stay low, rents will stay high. It becomes much more difficult for first-time buyers to get the deposit together to buy their first home. So we need an equilibrium point, and depending on what measure you use, that's around 3% vacancy rate, and we haven't had that for years. We actually haven't had that for several years. Even I think I was doing some research the other day. Even before COVID, before the federal election in 2019, the vacancy rate was 2.4 back then nationally.
Wow.
So, and now it's 1.3 or thereabouts nationally. So, there has been a reduction in the supply and rental supply happening for quite a few years. And now we're at a sort of crisis point that doesn't appear to be changing anytime soon.
In a recent episode of the Demographics Decoded podcast that I do with Simon Kirstenmacher, we spoke about millennials and how they're living differently to the generations that came before them. And a lot of them are putting off their decisions to buy a home till later. So it's not always that they can't get into the market. They choose not to. They have a gap year. They're not prepared to put their roots down. They're getting married later. They're having children later. But interestingly, they are getting into the property market. More Australians seem to be rent vesting at the moment, Nicola.
Yeah, exactly. And our survey has asked that question for quite a few years. Who would you consider being a rent investor? And I think is it sort of 45%? I think I don't have the numbers directly in front of me with that one.
I do have them in front of me, and
Thank
it
you,
was
Michael.
45% said. You're right, would consider, and that was up from 42% last year. So they want to get in the market, but they're not home buyers because that's not where they are at their stage of their life at the moment, Nicola.
No, and even like the ABS actually now tracks first time investors too, which I find quite interesting. And you can actually see that figure trending upward over the last decade, really, of people who are choosing to be rent investors. They maybe they want to, their work's in Melbourne. They like the lifestyle. They might live in St Kilda, or wherever. You know how much I love St Kilda, Michael. They might live there, but then at that point in their life, they don't want a really big mortgage. So then they go off and they might decide to buy in a major regional area somewhere around the nation. And because of the growth of property investment professionals around the country and people like Metropole, your company, that buy nationwide, they seek out the very best locations to invest in investment grade property. They're able to tap into these experts to guide them and to assist them. And, perhaps they stay as a rent investor for the next 5 or 10 years. And then by the time that they're ready to buy, they're probably in the position to do so in their location of choice. Whereas if they had bought at the beginning, like when they're in their late 20s or early 30s, and they perhaps, didn't have the finances available to do that. So that's a really savvy strategy, which more and more younger people are doing. I've done it several times during my life, and it has enabled me to retain my investment properties whilst moving around and living in other locations.
Now, one of the questions I know have been asked in previous years, and I'm sorry, I'm not sure if you asked this year, was where do you get your investment advice from? Because my gut feel is more and more people are getting it from social media, from TikTok, from this whole new group of unlicensed, inexperienced advisors. Another question I want to ask you about that in a second, but was there any sense of where people are, because the news is not where you should be getting your investment advice from. It's not the media's job to educate you. It's their job to get your eyeballs on their website pages that people are paying money to advertise on.
That's right. And just to clarify, our survey, the respondents of our surveys are skew more educated than most.
Yes, yes.
because we the people that fill out our survey, complete our survey, are generally sourced from our PIPA members, their own client databases, and so those databases are generally have people who have engaged with a paid property investment professional. So and you can even see that in our results, that generally our survey respondents own a few more properties than it is average, and things like that. So probably it doesn't, it's not overly surprising then that in our survey they do mention buyers agents, mortgage brokers, qualified property investment advisors, and the like of this is actually quite the predominant forms of where they get their information in regards to the professionals that they are tapping into. I don't have those stats in front of me, but I did think you might have them there, Michael, that there was still a reasonable cohort that actually got their information from family and friends, though.
Now, it depends who your family and friends are.
Well, true.
But in the old days, when I used to run seminars, I used to say, put up your hands if you've got multimillionaire parents. And if my kids weren't in the audience, probably no one put up their hands. So you've got to be careful who you give. Everyone's got advice on property. Everyone's got an opinion on property because they've lived in one or they rented one, but that doesn't mean you should be taking advice. I was impressed that your survey respondents suggested that people should be getting formal training or education before giving advice. And we know that, unfortunately, that's not required with property. So while I, many, many years ago, got my QPIA, was one of the early people to
Yes, you
get that
were.
qualification, not many people in the marketplace out there have got any qualifications or any experience. Last year, they were flipping hamburgers, and this year they're flipping
Mm,
properties and telling you how to
mm.
do it.
I mean, the barrier to entry, unfortunately, is extraordinarily low around the country, and not helped by the fact that we have state-based legislation in regards to many of the roles in
Yes.
real estate. And even, though someone might have a real estate license and be operating as a buyer's agent, sometimes they don't have much more than that under their belts. I mean, I've certainly, unfortunately, heard lately of an increase in the number of people who are buying in states and territories on behalf of their clients where they're not appropriately licensed. That's a big concern, and clearly illegal. So anyone who is, wanting to work with a buyer's agent or a qualified property investment advisor, preferably, and they are buying, suggesting buying in South Australia, but you're in Queensland, please make sure that they have the appropriate licenses to be operating in that state or territory, because that seems to be happening more and more, and is becoming a major concern at industry level. But yeah, like you say,
I remember speaking to a friend who's a client in the property industry in Western Australia, in Perth, and he was just mentioning how many so-called buyers agents were recommending over this year and last year for their clients to buy in Perth, but they never went. They never saw the property. They'd go to the local estate agent, and he was one, and basically they'd do a Facebook, a
full
FaceTime,
time.
a video, and that would be the only information from the person with a vested interest to sell the property, and they were taking a fee from their clients to give that sort of advice.
Oh, that's terrible. That unfortunately doesn't surprise me. I've heard of many things like that, and the way that consumers can safeguard or protect themselves is to ensure that they're working with appropriately licensed professionals, preferably those that are members of the relevant industry associations. Of course, PIPA, our members are across the industry, so we have members that are QPIAs and buyers agents and mortgage brokers and conveyancers and builders, and people that work in PR, and things like that. So that is investors need to take some responsibility for the people that they choose to work with. And just because someone has a lot of followers on Instagram, and drives around in a flashy Porsche, which is probably leased, it doesn't necessarily mean that they have the runs on the board necessary. And it's always vital to check the qualifications of anyone, because we're talking about hundreds and hundreds, we're talking about hundreds of thousands of dollars, like $1 million plus, in a lot of markets. So do your research on the people that you're going to trust your money with.
Interestingly, mentioning the Porsche reminded me of one of the PIPA board members, Veronica Morgan, wrote a great little post
Oh,
on
did she?
social media saying, would you trust the keys of your Porsche to a P-plater? So be careful who you
Mm.
get advice from.
Yeah, exactly,
Just
exactly.
recently, I followed a thread because I got an email about how you can make so much money in property, 25% in a year, and you could buy properties for less than $100,000. In fact, $50,000 and $70,000. So I actually followed it up a bit. There now again, there's somebody out there recommending buying in the United States. Imagine what you can get for
Oh,
$50,000 in the United States.
no.
Anyway, let's not
Oh,
go down that
no.
route.
I mean,
What
look,
I would
it's
like,
always important to encourage new entrants into the market. There, meaning a new entrants into the industry, the profession. We certainly do that at PIPA. And if they have enough experience and are appropriately qualified and licensed, then we welcome them into the association, because our role is to raise the standards of the people that are employed in the sector and educate them as well through our QPIA program, and by doing that provide a layer of consumer protection which governments don't do.
now, what is PIPA doing? So, the Property Investment Professionals of Australia and Metropole Foundation members, I remember
Yes.
way back over 20 years ago, there was a meeting of a couple of people saying, hey, we would like to see if we can get property investment advice licensed.
Mm.
We know the government's interfered in many ways, and we know how, despite all that you've been trying to do with a great board behind you, and you've been part of the board for a decade now.
The end of the year decade it
What
is,
is
yes.
PIPA now doing? How is it helping? Has it got any say with governments?
Yeah,
Is anyone listening?
yeah, I think look, at federal level, no one's really interested in has been speaking to us over the last few years. That might be to do with the particular party that's in power at the moment. So that agenda is still something that we would like to achieve one day. There's a lot of issues with having property turned into a financial instrument, I suppose. I guess one of the things that we've really been focusing on over recent years is representing our members and by proxy investors at various state government levels. We've had such a raft of rental reforms around the nation, and
Yep.
since about 2019, we've increasingly had a seat at the table, whether that's, I was involved in a public hearing for the New South Wales government recently. I went down to Canberra, I think it was a few months ago. I'm regularly talking to the state government here in Queensland. I know other board members do in other states and territories. So we're really out there representing our members and the wider industry and investors as much as possible to ensure, because for many years I think that we didn't have a seat at the table, and it's important that we do, regardless of sometimes whether they actually listen to us or not. But we have had wins over the years. Clearly, we were involved in the campaign which ultimately resulted in the repeal of the interstate land tax
Yes.
here in Queensland. We've also been involved behind the scenes of tweaking of legislation that may have come in if there hadn't been some insights from our side of the fence. So we're generally out there doing our bit, doing as much as we can, considering I still say we're a small non-profit, but we're not as small as we used to be. And we've got hundreds and hundreds of members all around the nation now, hundreds of people who are qualified property investment advisors. We have new students enrolling in the course every day. And so in lieu of that regulation for our sector, I suppose we've kind of created a niche for ourselves to be self-regulatory in a way. And I would love that, no consumer who is wanting to buy property as an investor, I would hope that they always would preferably go to the PIPA website to check if somebody's a member before they decide to work with that person. And that's one way of safeguarding, their results as well as their financial futures.
Well, I'm going to leave a link to the Property Investment Professionals Association's survey because it's got a lot of extra information we didn't have a chance to talk about, such as what investors' exit strategies are.
Mm,
Many wanted to hold and never sell. Some were planning to sell down. I was surprised that close to 20% were unsure of what their exit strategy is.
yeah.
I guess they should really have worked that out before they started. That's one of the problems where a lot of people don't start with a
Could you
strategy.
imagine what the result would be if it wasn't sort of a survey, like the cohort of survey respondents that we have who are more
Yes,
educated?
yes.
If they're 20%, imagine what the general population is.
Definitely. Yeah. Oh, look, most people think buying a property is a strategy. It's not. The property you eventually buy should be the physical manifestation of a whole lot of decisions you make and make in the right order before you even talk about location or the type of property. But thank you and your board for going to so much trouble preparing such a great survey. I know I heard you say that you're going to dig deeper and get some more
Yes,
information out of it. So I look forward to chatting with you again about that real soon. Thanks for your time, Nicola.
always, Michael. Happy to be here.
Well, there's lots of information in the PIPA's survey that I will leave a link in the show notes to. But before we have a chat in my mindset message that seems to be very popular, lots of people leave great comments about this, I want to remind you that I do another podcast each week with Simon Kirstenmacher that we call Demographics Decoded, where we unveil the trends that are going to shape our futures. Really important information for property investors, for business people, for entrepreneurs. If you don't subscribe to that, please, wherever you're listening to this or watching this, click on the app and subscribe. Look for Demographics Decoded. And if you got benefit from today's show and you don't currently subscribe to the Michael Yardney podcast, please subscribe to that so twice a week you get information from my guests and me. Now, I guess what you heard when I spoke to Nicola McDougall is that property investors have successful investors have a long-term focus, and while some are getting out of the markets, many of the others are staying in. So my question to you is, as we're coming up to the end of the year, are you taking charge of your financial future? We can't leave it to the government. We can't leave it to outside people. And my team at Metropole specialise in helping Australians like you achieve financial freedom through strategic property and wealth advice. Sure, we're Australia's largest buyer's agent, but we're much, much more than the buyer's agent. We actually help you, whether you're a beginning investor or a seasoned investor. We help you, whether you're looking for a home or an investment property, by helping you plan to become the people you plan to become. It all starts by putting a personalised investment plan together. Remember a moment ago I spoke with Nicola, like that most people don't even have a plan. We understand that every investor's got unique goals, unique circumstances, and that's why we tailor our strategies to fit your requirements. We have a customized approach to help people get success. We've got deep market knowledge and an end-to-end service, including finance, wealth advisory, property acquisition, property development, construction, and property management. And we've got a successful track record. In fact, a recent survey of the results of our clients showed they're 7.3 times more likely than the average investor to own 6 or more properties. And then we have ongoing education and support. So why not go to metropole.com.au and organise your own complimentary wealth discovery consultation with one of our strategists.
Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
In my mindset message today, I'd like to share with you 5 lessons that you must learn if you want to become successful, more successful in life. Look, they say the road to success is paved with failures, and speaking from personal experience, I know that's very true. But I'd like to share with you 5 lessons that I believe you should learn if you want to become more successful. Look, you may have already learned some of these the hard way, but you still have a chance to learn the others without necessarily having to go through unpleasant experiences. So the first lesson I want to share with you today is, if you haven't failed, you can't succeed. For you to succeed, you must have previously failed. There's nobody who's a success today who hasn't previously failed. One thing that successful people know better than most is not to quit when they fail. I almost said not to fail, but they know that they need to. You can hardly succeed in anything the first time. I mean, the world's going to test you, nature's going to test you, life's going to test you. Maybe that investment you bought isn't performing as strongly as you might like it to do. Hey, that's a test. It's a test of maybe you should change your strategy. Maybe the career you've spent lots of time being involved in isn't giving you the rewards you want. Maybe that's a test that you should be doing something different, changing careers, changing professions, changing jobs. Maybe the business you devoted your life to and your resources to isn't yielding the profits you want. That's a test. Most successful people that I know have acknowledged that they got their biggest break in life immediately after a heavy disappointment, when they were thinking of quitting. So in my mind, it doesn't matter how much you fail, as long as you persist and change and learn from your failures, then you're going to succeed. Because remember, no one is born a failure. The second lesson I'd like to remind you about if you want to succeed in life is that money is just a reward. If you truly want to succeed by any standard, whatever your standard is, then money shouldn't be your major motivation. Now, don't get me wrong. A lot of people have succeeded because they've wanted to be rich, but none of these people have succeeded without first adding value or without first solving a problem. Money is the reward for value. Only thieves want to reap what they haven't sown. The third lesson I'm going to share with you today is to get what you want, you have to help others get what you want. I was taught many years ago by one of my early mentors, Zig Ziglar, who said you can get everything you want in life if you just help enough other people get what they want. One of the things that keeps me going in life, writing more articles, speaking with clients, recording podcasts, is the desire to help others develop financial independence, to help them get what they want. If you can make helping others a lifestyle, you're going to be surprised how quickly you're going to discover your purpose and begin to achieve your dreams. There's power and fulfillment in helping others. The fourth lesson I want to share with you is people are going to disappoint you. If you want my advice, get used to it. Unfortunately, this just happens and you wonder, why do bad things happen to good people? But it's your attitude to disappointment that's going to determine how far you go, especially in your relationships with clients, with employees, with colleagues, and so on. No matter how much people disappoint you, you still have to trust people. Accept that everybody deserves a fair first chance. You're also going to you need to learn how to control and manage your relationship with people at all levels. That's the key to your success. And the fifth of the 5 lessons I'd like to share with you in this mindset message is the first steps to your success is clarity of purpose and direction. You can succeed in whatever you want, whatever you're determined to succeed in, but first you've got to find your purpose. And walking in it makes everything easier. This is because if you do find your purpose, you're going to actually be using your natural talents and abilities. Find your purpose, chart a course, chart where you want to travel in life. Doing this makes it so much easier for you, and I can assure you your success is going to be so much easier to find. So there you have it in today's mindset message, a couple of lessons that I've learned along the way from my mistakes in the hope that it'll help you make fewer mistakes. Thank you for spending the last little while with me. I hope you got some benefit from today's show. But before you move on to the next podcast you're going to listen to, let me remind you that I have another show that I produce once a week with leading demographer Simon Kirstenmacher that we call Demographics Decoded. Now, this is a must-listen to podcast or watch podcast, in my opinion, for anyone who's interested in property investment, but also for business people and entrepreneurs. So if you don't currently subscribe to Demographics Decoded, just please stop for a second, subscribe on your podcast app, wherever you're listening to this, or on YouTube. And of course, if you don't subscribe to this show, the Michael Yardney podcast, click on the follow or subscribe button wherever you're listening to this show or watching this show, so that twice a week you're going to be given information from my guests and me. Now, I've got a little favour to ask you. If you did enjoy today's show and you know somebody else who you think would benefit, please tell them about the Michael Yardney podcast and Demographics Decoded. Now, there's a share button on every podcast app. On Apple Podcast, there are 3 little buttons on the top of the player. Or just do it the old-fashioned way. Somebody told you about this show, or you found out about it, I guess, in some way. So why don't you tell them? Because I hope you're going to be doing your friends a favour, and you're definitely going to be doing me a favour in helping me in my quest to help as many people as possible to become financially literate. Oh, by the way, I've got a special bonus for you as my way of saying thank you for subscribing to the show. Just go to podcastbonus.com.au. I'll leave a link in the show notes, podcastbonus.com.au, where I've got a bunch of ebooks and reports. Just my way of saying thank you for taking the time to listen. And remember, all the information we have in these chats, in these podcasts, is general advice. We don't know your personal circumstances, so it's not specific information. But if you want more detailed, specific information about your own circumstances, why not have a chat with my team at Metropole? I'll leave a link in the show notes, metropole.com.au. If you really want to learn more, why not have a listen to the previous podcast, the many episodes that are on the various podcast players? Just go back to any of the old episodes. Each have got great lessons about property investment, success, and money. Well, once again, thanks for listening to today's show.